So back in April, when others were kind of panicking and bracing for the turbulence in the market, you predicted a V-shaped recovery for the market. So what did you see that gave you confidence to make that call?
Uh, well, as you know, it's not easy to make those calls because in the heat of the moment, things were really uncertain. But we are an evidence-based research firm, and we have about 10,000 clients, and so we're in constant dialogue with our clients. And two things were very obvious to us. One was that when markets fall as quickly as they did, it's called a waterfall stock market decline. And there have been 12 precedent waterfall declines in the last 100 years. And of those 12, as long as you didn't slip into a recession, now that's a big condition, then those are panics that see a V-shaped recovery. So our bet was that this would look like the 8 prior instances of a market panic, and then we would have a symmetric recovery. COVID was actually was the most recent example of a similar panic decline. And the second reason we were making that call was that in our conversations with clients, we noticed that there was a massive perception gap, that in their minds, the tariff uncertainty introduced an extinction level event for the economy. They thought that this was going to create a collapse in economic activity, and one that would even force them to get money out of the system. So I think that perception gap, as you know, is not only always you have to fade that, but it played out in the VIX, which jumped to 60. And we know that you want to buy a VIX when it's above 60, but what we had published within 10 days of that April period is that whenever the VIX then closes below 30, that has always confirmed that the low was in place. And so that helped sort of, give us more conviction that the bottom was not only in place, but then we should follow the playbook and assume it's a V-shaped bounce.